So the bottom line is, if deals work at today's short-term bridge debt numbers, they're going to work really well at what today's stabilized debt numbers are, and even they will be screaming hot at what tomorrow's short-term debt numbers are.
What's going on, everyone? Welcome to another episode of The Remote Investor. I'm Michael Albaum, and today joining me, I have a very special guest. He is an author, investor, syndicator, father, and just all around kind of a cool dude, Matt Faircloth. Matt Faircloth, good to see you, man. How are you?
You too, Michael. Good to see you again, man. How you been?
All good, but crazy. We're expecting our first kid, just finished remodeling our house, investing, building company. Yeah, it's nuts. Just all kinds of craziness, but all kinds of good stuff.
Remodeling a house, right with a kid in the oven too, huh?
Yeah, because I mean, why not? Like, isn't that what everybody does?
Why not fill your plate? No, that's what we did too. But it's funny, it's like correlated, right? That my wife and I just like, hey, let's just fill our plate up, right? Let's do all the things, right?
Right. But did you guys know that you were pregnant before you started the remodel? Like, what was the order of operations?
No. We knew we were, we were pregnant with our second child. And we bought the house. We lived in a townhome, bought the house attached to the house that we lived in, the house next door to us. Gut reno that with my wife pregnant with our second child, with a 2-year-old running around. Okay. That's old enough to walk and old enough to be dangerous as hell. Right.
Right. Pick up power tools. Step on stuff.
They don't know what's going to hurt them. What's not. They just think, oh, whole world's a big toy, right? Whole world's my playground when I'm 2, if it makes noise, all the better. So I would take my 2-year-old walking on job sites because mommy needed a nap because mommy's laid out 7 months pregnant. Right. So I would take my 2-year-old, hold him, not put him down, but he's too big to get held the whole time because he wants to get down while contractors are working and stuff like that. So that was just hell on wheels, brother. But it was great. But we got out. We ended up renovating that house and then renovating the home that we lived in right after my wife had our daughter, and then moving. All that within like a year or so span. Looking back on it, Michael, that year and a half time were like, that's where the most stories and the most fun, and you look back and that's like where the most memories were made of life. I can't say it was all fun. It was all great because it was a lot of hell, a lot of bullshit went down during that month and a half or year and a half time. But it was probably one of the most memorable times of the last 10 years. So
I love it. We're definitely right there with you. We're a lot of memories, a lot of stories.
You're making so many memories. And like when the what hits the fan, just know this is going to be a phenomenal cocktail hour story one day. Like
absolutely.
Yeah.
So Matt, like, I know your background. I know what you do. For all of our listeners that might not be familiar with you, they've clearly been living under a rock for the last decade if they don't know you. But give us the quick and dirty who you are and what it is you're doing in real estate.
Yeah, man, no problem. My name is Matt Faircloth. My company's been around for 20 years now as a real estate investment firm. We are active in multifamily investments, and in the past, I did many fix and flips, small rental deals, BRRRR strategy. Back when it was cool to do, back before it was called the BRRRR strategy.
Right.
Back when it was just buy it and refinance it. We didn't have cool names like that back then, but. Done a lot of the different real estate ventures, and we've grown those things and grown our business a lot of times with our own money, but also a lot of times with other people's money. And that is the impetus of my book, Raising Private Capital, which is a Bigger Pockets book, an Amazon bestseller, Raising Private Capital, how to leverage other people's money to build your business.
I love it. And so you took the extreme version of OPM. You said, okay, I'm not going to use other people's money. I'm going to use other people's money to then build your business. So talk to us about that. Like, why did you decide to go into the syndicating world as you had so much success doing BRRRRs, flips, all the other rental strategies are out there? What enticed you about this syndication model?
Well, what's funny, Michael? Like, it'd be great to say, Michael, I had this plan, this whiteboard with like this entire 10-year vision for myself. Right. And I said, I'm going to be owning thousands of units of apartment, which we do now. We own a couple thousand units of multifamily now. And that's impressive to say. And it'd be great to say, I was sitting with a cognac one day, Michael, and I wrote all this down in a notepad, just visioned out the last 10 years of my life, exactly how it was going to go. Right. Unfortunately, my friend, that's not how it went. This is how it really went down. It was like 2010, right after the crash of 2008, which was an absolute red hot mess. And we were just recovering from that. Things were starting to come onto the market. And my wife gets reconnected with a guy she went to college with on LinkedIn. And they have a conference call to get like back before we were doing Zoom and whatnot. You literally pick up the phone and have a conference call like, hello, how are you? And they would have a phone call check in, like, let's get reconnected. Here's what you're up to. He's a financial planner now up in New York City. And she mentions, well, my husband's investing in real estate and running a real estate business. And she had a job at the time as a salesperson. And this guy says what I tell my students now. These are the magic words, man. Magic words are real estate investing. That sure sounds great. I wish I could do that too. I just don't have the time,
right.
And ding, like, well, tell you what, I got the time.
Right.
Right. Like, I got all the time you need, brother. And so my wife said, you should talk to my husband. So I took the train up to New York City to meet, because he's in New York now. And so I go and sit down, have coffee with him. And he starts going, well, if I were to, I laid out our whole business, told him what we were up to, some things that we've done. And he just goes, well, what if I gave you $50,000? And I'm like, what if you gave me, you're right. That's a great question.
Great question. Yeah.
Let's keep asking that question. What if you give me $50,000? And I'm like, well, I could probably, at the time, Michael, it is a time that, nobody should ever wish this should happen again. It was right after the crash when everything was cheap and nobody had any money and banks weren't lending. And so if you knew how to get deals done, you could get some crazy deals done. And so I knew a couple wholesalers that knew how to do short sales, which is where a bank is owed X and you can convince the bank to sell it for a fraction of X. So he had a couple of townhomes that I'm not afraid to say, it was a while ago, that the owner owed $150K a door on these townhomes. The wholesaler was able to get him down to where I could buy both of these townhomes for 50 grand all in. Now they were destroyed, right? They were like, the total debt was 300 grand. I bought them for 50K because they were in Trenton, New Jersey, not the greatest block, not the greatest town of the world, not the greatest block of the world, not a lot of things.
Yeah.
And they were destroyed too. So he gave me 50K in equity. I then found a friend that had a retirement account, another real estate investing buddy, and he had been borrowing money through self-directed IRAs from some friends of his through his job, because he was one of these guys as his day job, but also did some side investing, right? And he said, hey, I had this retirement account and I can't put it into my deals. Can I put it into your deals? And I'm like, yes, you can, if you teach me how to do it, because I don't know what you're talking about. So, right. So I'm like, yeah, man, sure. Give me 50 grand. So this equity guy gives me 50 grand. This IRA guy gives me another 50 grand. And with that 100,000, I buy the properties with equity with the 50K. And I took the 50K in IRA loan and I rehabbed them. Right. So I did a bird deal, but a small little kindergarten size bird deal, bought the properties, did a gut reno. They're both 2-bedroom, 1 baths. Leased both of, so I was all in for 50K a door. Now, yet again, guys, you can't wish for the past to happen again, but this is what happened back then. It was easy to do 2% rule stuff. So I leased them both out at $950 per door, right?
Okay.
Which sound like, oh my goodness, 50 grand all in, $950. Yeah, rents are way up now. Prices are up too. I get it. We were able to refi both of those properties at a valuation of 75 grand a door. Right. So I had a bank that was willing to come in, super conservative valuation. So I was able to pull the equity from my equity guy back out, gave my IRA guy money, all back his money. And of course, the equity guy is like, that's amazing. Let's do that again. And then he went and got 3 of his other New York friends. And before you know it, he's bringing his buddies on the weekend on the train down to Trenton, New Jersey, and I'm loading them all up in my car and giving them the windshield tour. I'm like, oh, let's not go down this block. Let's run that stop sign, and then I'm showing them the good neighborhoods. And this guy and I partner up. And before you know it, he's kind of my investor feeder of bringing in some of his local friends from New York. And I built out, me and that guy probably did 30 units together.
Wow.
Of onesie twosie BRRRR strategy deals like that. So long answer, very, very long answer to a short question, Michael. I did not decide I was going to let's go buy multifamily syndications or whatever. Liz and I, my wife, started very small and built out. And so we did those two little duplexes, those two little single family homes, excuse me. Then we bought a duplex and a single family home next door to it. Then we bought a couple of 4 units in a row. Then we bought a 10-unit apartment building. Then we bought an 18-unit apartment building. Before you know it, Michael, we're off to the races. And then that grew and grew and grew to the point we were doing deals out of state and everything like that. So there's way more story to it there. But that's how I got into raising capital, is because somebody offered it to me, and I said, you know what? I'm not trying to do this, but I will figure it out with you. And he knew that. He knew I'd never taken money from anybody else before. But I said, let's figure it out. And we did.
I love that, Matt. I just want to kind of go back to what you said with the numbers for a minute, because you kind of glossed over it like it's no big deal, but I think the impacts are so huge. You bought the thing and rehabbed these 2 units. You're all in $100,000. Then you went and refinanced them. You said you pulled 75 grand out, or that was the value?
I got a valuation of a total of 150 all in. So 750 a door. I got a valuation. So what we got out, I had 100 grand of investor equity and debt into a property. So very like low debt, reasonable amount of equity. And people have forgotten how to do that. That's still what we do on our multifamily stuff. We go in with a little bit more equity and lower debt, because I'd rather be that just in case. Right. So we refi out at 100,000. We got a loan at just about what our 100 grand dollar was. Right.
Okay.
And so that gave my IRA guy money, all his money back, plus his interest. And my equity guy got fully restored and got all his equity back in. So then he and I were 50-50 partners. So then I got 50% ownership of these 2 townhomes that were cash flowing to the tune of like $350 a door, at the time. So I got 350 at the time. $350 was a ton of money, Michael.
Oh, it was killer.
So I was like, boom, slaying it, right? So I'm making 350 with no money out of my own pocket, and my investor buddy put 50 grand at risk, but then he got it all back, and now he's making 350 with his eyes closed, with Matt doing all the work, right? Matt running around collecting rent, Matt leasing the units up for him, Matt managing the construction and doing maintenance and all this other kind of stuff, right? So it was a win-win across the board. And my IRA guy, of course, is like, that was amazing. Let's do that again. And so he became one of my biggest IRA investors as well.
Man, I love it. I love it. I think a lot of our listeners, Matt, might be hearing that story and being like, yeah, that's super cool for Matt and his IRA and equity guy, but that was, over a decade ago. What about today? Well, how do I invest and make kind of returns today? So talk to us, like, what is it that you're doing today? How are you structuring deals? How are you thinking about the investment landscape?
Well, people are looking at what I'm doing today and like, oh, well, I wish I could do like the last deal we did. We did a 36 unit new construction deal out in Minnesota.
Wow.
Raised 1.8 million to do the deal. Right.
Okay.
People hear that and they're like, wow, I can't do that. Well, guys, I didn't start there. Start where you can start. Right. Everybody listening to this podcast, everybody not listening to this podcast, the brother-in-law of people listening to this podcast, everybody has in their cell phone millions of dollars, right? If you know how to unlock it. If you know how to unlock the dollars in this handy-dandy little magic box right here, your cell phone, you've got so much money to go into your deals. And I'm not plugging my book, Michael, but hey, go read the book. It's, costs you $20 and it'll tell you how to unlock money out of your own network. And I promise you, there's no downline program, nothing else. Just read the book. It'll tell you how to unlock money. That's it. That's all you got to do. How to unlock the money out of your own network. And that's what I tell people that they can do. Yeah, you might not buy properties at $25,000 a door, but you can still do something with that money if you've got the inside track on deals. If there is a real estate agent listening to this deal, why do you got to sell every great deal you get to a buyer, to another buyer? Why can't you sell a deal, do a deal, then sell a deal, do a deal, right? Why can't you do some of it? Why can't you cherry pick and do some of the deals you come across?
Yes.
Well, you can. And just because I don't have the money is never the right answer. You can do these deals you have with the people you already know in your cell phone.
What's the name of the book again, Matt? Where can people find
Raising Private Capital.
Amazon, Bigger Pockets.
Amazon, Bigger. Yeah, Jeff Bezos or Bigger Pockets will sell it to you. But Raising Private Capital, not, there's another book that's very similar title, not that one. Raising Private Capital.
Love
Yeah.
it, love it. So, all right, man. So now you're doing multifamily stuff. I don't know if you're aware, Matt, but interest rates are crazy. So you probably
Oh,
stopped
I'm
doing
aware,
deals,
brother.
right?
I
You
look at the
probably
10-year treasury 2-3 times a day, man. It's like, and I looked at it today. I was like, oh God, that's not what I needed to
it's
have
going the
happen
wrong
today.
direction. It's going the wrong
Fuck.
direction.
Good night. Yeah.
But so how are you still managing to do deals, especially with like development type stuff where you're you're locking in debt down the road, and walk us through like what you're still doing today.
We are doing some new builds because I'm accepting the fact that money is expensive now, under the premise that money will get cheaper down the road. And
Yeah.
so I am like running into the wind, and doing what I'm observing the masses and doing the opposite, Michael. So we are getting into high debt property, like projects like that new build,
Yeah.
in that. But what's happening is that new build we just finished in Minnesota, we finished it at 9.5% interest debt. I'm about to refinance it at 6. Okay. So that'll be a cash out for our investors. That'll be cash flow and everything like that. So the bottom line is, if deals work at today's short-term bridge debt numbers, they're going to work really well at what today's stabilized debt numbers are, and even they will be screaming hot at what tomorrow's short-term debt numbers are. So I like doing either major gut reno. None of this, like, we did a lot of value add stuff back in the day, back before COVID and a little bit into COVID, before rates took off. Mm-hmm. We did what I call like a little bit of lipstick and mascara, so to speak, on the apartment building to bring it to the next level. That did well. And most people call that value add. Now we're not as interested in that because the market's gone up a bit. We're now interested in doing heavy roll your sleeves up, that either new builds or we're gutting a warehouse in Minnesota right now and turning it into 15 apartment units. Because I can get work, I can control the cost of work through right contractor relationships, and I can accept the cost of debt at today's terms, knowing that today's short-term bridge debt is going to be cheaper once I refinance it.
Yeah,
so
that makes a ton of sense.
That's been our model. So
I dig it, man. I'm just curious, like, why are you doing the roll your sleeve up super heavy stuff, and why have you gotten away from the mascara and lipstick?
Because what's happened in the world, and a lot of people are like, oh, I can't get good deals. I can't find good deals. Well, the reason you can't find good deals for 2 reasons. Cost of rents have gone up, and that's kept the price of properties up. People thought that property prices, especially investment grade property prices, would start falling off the map when interest rates went up, right?
Right.
Like, well, hey, interest rates drive cap rates. So if interest rates go up, that means cap rates must go up too. And so everybody's kind of sitting here rubbing their hands saying like, oh boy, rates are finally up. That means
it's about to get good.
Start to get reasonable. Also, no, because cap rates don't drive. It's not the whole thing. That's not the whole equation. What you're also forgetting is NOI, the bottom line on what a property produces in cash flow. And so if rents go up, and they have been, if rents go up, now they're plateauing and coming back down in some markets, but don't forget they've gone up a lot in the last 3 years, right? And so because of all that, property prices have gone up to a point, Michael, that a real life example. Look at a deal, 1970s build, older than me and you, Michael.
Yeah,
down in North Carolina, and they wanted like 80% of what it would cost to build it. And I looked at that and I'm like, am I taking freaking crazy pills? I could build that for 20% more. I think it was like 150,000 a unit, is what they are asking. And I'm like, I could build this for 180 grand a door. I'm building a 30 unit in Trenton, New Jersey right now for 175 a door. I know exactly what it costs to build because I'm building it. Okay.
Right.
So
you're doing it.
I'm doing it, bro. I know. I'm paying the damn bills. I know exactly what it costs. My hand shaking as I write these checks to these construction companies for building these apartment buildings, but I know what it costs. It's
Yeah.
making it work, right? So I'm like, I also know that a prospective tenant is going to pay more to live in a either new build or a really cool gut reno. Not to don't just go and they're not going to like pay me top tier rents if I just put a coat of paint on it and put in stainless steel appliances, which that was the value add game up until
Right.
recently, right?
Right.
They're the tenants are going to be a little more scrutinous, and those that have the few extra dollars are going to look for the best deal they can, right? And that best deal they can is either going to be something really funky and cool like a gutted warehouse, or a really cool new build that they know is going to not have maintenance issues, that maybe has some nice amenities, or maybe just there's something about living in something new that nobody else has lived in.
Yeah.
It's there's nothing like the smell of brand newness, everything,
Totally.
and so because of that, the rents the market will bear for new things is higher as well. And so by that equation, if I could rent it for top tier of the market, whatever the market is, if I'm going to get the best rents that the market will bear because it's new, number one,
Mm-hmm.
and I can build it for a little bit more than what the knucklehead's selling a 70s vintage down the street that's got cast iron pipe and has electrical issues and it's got a leaking roof.
It's going to be a nightmare
Right?
to insure.
Yeah. Right. And with the insurance going up 3 times, because by the way, Michael, insurance does not go up like that on new builds. Right.
Right. Right.
Yeah. But so I that's why I was like, you know what, let me put the crazy pills down and let me not do deals like that anymore. So we decided that we wanted to create massive value by building and doing guts, and deliver top tier product to the market versus kind of chasing and trying to do these big value add stuff. And we'll still do a value add deal if the numbers work, but guess what? The numbers don't work. So,
Right. Right.
yeah,
Right. Right.
yeah.
So what changed? Was it like a mental thing for you having this aha moment of, oh, I can do this for 20% more? Or was there like a literal change in cost of, materials are materials, whether they're going in a rehab or a new construction. So did you have this aha moment, or was there something that shifted in the market that said, this value add stuff doesn't make sense anymore. Let's go do new builds?
No, it's like that. Well, for example, the lot in Trenton, for the longest time, the only way for that project to work was for there to be major subsidy involved, like LIHTC, low income housing tax credits, government money coming in. And these are all okay programs because they're there to create housing for those that need it, to keep housing affordable. All those things are great, but we wanted to do that deal market rate. I wanted to just build it and be able to charge what I wanted to, which in Trenton, you can't charge too much because the market can only bear but so much, right?
Yeah.
So it's all fine, it's fair, and it's still going to be an affordable building for the market. But for the longest time, we weren't able to get it built. But market rents came up and up and up and up, and we were just sitting on this piece of land, and it got to, and I was like, you know what, we didn't pay much for the land, so I'm going to just sit and wait for the market. I saw what was happening, and I'm like, I used to get $750 for a 1-bedroom. Now the market's at $850. Now the market's at $1,000. Now the market's at $1,100. Now that building we're building, Michael, our projections are to rent those 1-bedrooms for $1,500, right? And friends of mine that are Trenton landlords still, Michael, my wife and I used to have 115 units in Trenton. We've sold everything now, but now we're building a new building there, right? My buddies that are Trenton landlords have looked at this asset that we're building and they said, oh, you're going to get more than 15. And I go, we're getting, 16 for a renoed 1-bedroom down the street,
Wow.
Now it took years and years and years for the market to come up. But what happened was, as rents have come up, you still gotta be careful on what you pay, but rents in some markets have caught up with the cost to construct to make it cash flow make sense, right? And so if that's the case, that's what shifted. It wasn't like an immediate over the night light bulb, but this is a guy doing value add down in North Carolina, doing value add, and we have a lot of value add in Kentucky going on right now. So we know the value add game, and we know the equation that it takes to make that work. The first element in the equation was we went a year and a half without buying anything as a company, and we had enough going on with our current value add projects that we were fine. But it was frustrating, and we were like, man, we just can't seem to make anything pencil anymore.
Yeah.
That, along with, hey, wait a minute, the numbers work on this Trenton deal. And so I started to run it, and I said, wait a minute, like it seems like new construction all of a sudden makes sense. And I mean, it's funny because the secret's not all the way out yet in the market, and not everybody's figured this out yet, that wait a minute, if I can acquire the land for a reasonable number, or if I'm the owner of the land, or if I own a piece of land that's got a little side parcel, if I can get that side parcel approved to build something new, if you run the numbers on it under today's rents, it actually might make fiscal sense. And so that's what I think the opportunity zone is right now. There's not like bajillion cranes in the air. Not everybody's building right now because people are a little uncertain about the economy. But the fact of the matter is, the numbers on new construction and major reno, all of a sudden, because of rent hikes, they work now. It does. And once you've got that property built, as long as you're not in a market like Austin, Texas, or whatever, where there's a crane, like there's three cranes on every block, because then that's just all going to create lots of competition. If you're not in markets with lots of building happening already, you're going to be able to command the best rent the market can bear because you're going to have the best product.
I dig it.
So
I think that's awesome.
So there, Michael.
I love it. Hey, where in Kentucky you invest? I'm just curious. I invest there a lot too.
Lexington.
You're in Lexington. Okay. So I'm up in Covington. My property manager has an office down in Lexington with the partner.
Where's Covington?
At the border with Cincinnati.
Yeah. That's like, so we couldn't get the Lexington airport's tough to get into. But there's been times where I had to fly into Cincy and drive down to Lexington. It's only 45 minutes down the road.
It's super close. Yeah, it's super close.
Yeah. Lexington, Kentucky is like a commercial for all your listeners. You got to find like little nuances. Did you know Lexington is surrounded by all these horse farms?
Well, that's where all the Derby horses come from, right?
They are, and they go to Keeneland, which is the bougie racetrack that's right there. Not Churchill Downs.
Churchill Downs, yeah.
Yeah, at Churchill Downs they drink Bud Light. At Keeneland they drink champagne.
Okay.
It's like fancy pants, stick your finger out. You got to dress nice. Right. Keeneland is right there next to the airport. They love their horses down there, and there's 400 horse farms all around the city of Kentucky, and they're all deed restricted. So if you understand how deep the horse culture runs in places that are horse places like Kentucky, you'll understand they will never, ever, 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 ever build on those horse farms because they're too valuable to the culture there, right? And so that, Michael, makes Lexington, it might as well be like a piece of Hawaii. It's an island. It's out in the middle. It's out in the middle of the Pacific Ocean because you can't expand the city. And as the city continues to grow, it can't go anywhere. It can only become more dense and push inward, because of all these, horse farms. When you fly in, it's the wackiest thing in the world. You see this major city surrounded by green. Yeah.
We got to hop off this podcast, Matt. I got to go call my agent and say, hey, go find some deals in Lexington. That's awesome.
Yeah. And the bourbon is phenomenal, and the horses are really cool. We've visited a few of the horse farms, and everything like that. They love it. A lot of our tenants that live out there work on the horse farms, because we do like affordable housing and C-class workforce housing and that kind of stuff. And so we house a lot of the folks that support that industry.
That's great. That is so cool. Yeah. That is so cool. Well, Matt, let's shift gears here a little bit. I'm curious, like from your perspective, because I've chatted with a lot of syndicators over the years. We've had some on the podcast. Everybody talks the talk, promises, with big stuff. Like, what is it that someone should be looking for if they're thinking about putting their money into a syndication? And what are some red flags for you?
The truth. They should be looking for the truth, Michael.
Yes, absolutely.
If it sounds too freaking good to be true, that it is, man. The bottom line when you're looking at syndication deals, look for experience. And there's a lot of those without experience that have fallen off quickly, right?
Especially in the last couple of years.
Yeah, man. Next thing is I'll get you to a real equation to look at when you're looking at syndication. There's two numbers that you want to pay close attention to, right? Number one is the cash on cash return that the deal will pay you once it's stabilized. And anybody that's in a value add deal, like for us doing new construction, hey man, I'm building this thing for the next year. And so no, it's not making any revenue because it's not leased, right? It's not going to pay you anything for the first year. But then once I'm built, I'm going to pay you 8, 7, 6, 9% return, right? Then so that's the cash on cash return. Once it's stabilized, it's going to make this on an annualized basis. Then what you want to look for is what the IR they love to talk about, the IRR that the deal makes, and that's the number that syndicators love to manipulate and inflate. And the way they do that is by projecting higher out sales than reasonably realistic.
We're going to sell it at 2.5% cap rate, and
that's it. Almost sell it for 3.5 times what I paid for it by finding myself a bigger idiot than me and playing hot potato. And that worked up until recently, and there was a lot of syndicators. If you just look on social media, every syndicator on social media was apparently brilliant and making millions of dollars in returns for their investors. But those syndicators that were making all those returns for those investors are now out there buying car washes. Like they're not, all of a sudden they're not doing multifamily anymore, huh? Now you're buying car washes. Now you're doing laundromat deals or whatever it is you're doing, huh? Okay. The reason that like those deals ended up not panning out is because they like you said, low cap rates. They projected interest rates to be much lower or whatever than they were going to be on the out sale. And so what you're going to see, guys, is you're going to see low cash on cash during the hold cycle, where it's like, well, this deal might only pay you 5%, 4% while we own it, but just you wait, Mr. and Mrs. Investor. Somehow magic fairy dust is going to get sprinkled, and we're going to refinance it in year 3 and give you most of your money back. And then you're going to make a 25% cash on cash return. And then we're going to sell it in year 5, and you're going to average out to an 18% IRR. That's what's going to happen. What you're looking at there is future. You're predicting the future. The syndicator is looking into the future and saying what the future is going to look like. I don't like deals like that. I like deals where at least 2/3 of the profit you're going to make as an investor are coming back to you real time, like once you're stabilized. I don't want to make low single digits now. And my wife and I passively invest too. And so I don't want to look at a deal where I'm going to be making low single digits, holding my breath, hoping that I'll make mid-teens someday when it sells. Not for me. So that's what I caution people to look into. We also, as a company, have gotten more into funds. Because then you can kind of have it's like whack-a-mole if you invest in syndications, in one-off syndications. I think you're like this deal, like, okay, you got lucky, you got into a deal that really, really worked. This deal right next door to it that the syndicator did might have had some major issues, might have had some problems. We've had individual deals that had problems, and I've looked at the model and said, this one-off syndication deal, I don't think is a good way to do it. I like the fund model, and some guys have grown too fast with funds. They've just raised funds and just raised bajillions, I guess that's whatever is after a trillion is a bajillion.
That's a bajillion.
Yeah. So they've raised bajillions because they've got a fund and because they're wide open or whatever. I would want to do it that way, but I do like the model of funds because you can blend out the cash on cash returns and get a reasonable expectation to investors. So, money talks. So if you're looking to invest, look for something that's going to pay you as much as reasonable now, with a little bit of icing on the cake later. But don't take all your profit. Don't expect a ginormous cherry on the top and make that, and don't try and eat off the cherry. The cherry should be like a little dollop on the top, on the back end when you sell, but a lot of your money should come during the hold cycle of the property. We have a fund that just issues hard money. It just issues short-term bridge capital. What I love about that is it's all cash flow now. There's no future. There's no betting on the coming. Whatever I make this month is what you get. That's it. And that's what we pay investors. There's no like, cross your fingers, guys. You might be able to sell it for double what we paid for it sometime in the future. I think cash flow, Michael, is going to become more in fashion. Appreciation's been where the cool kids were, and whatever people were bragging about on social media and stuff like that, about all this appreciation they made in real estate. I'm not sure if real estate is going to appreciate a ton over the next couple of years, the next 5 years. I don't know if I need it to. I'd rather just do deals that cash flow now and to have cash flow increase over time marginally through marginal and reasonable rent increases, through keeping expenses down, through good management, and just cash flowing. And then at some point when the market's favorable, I can sell. But I'm not just like holding a hot potato and hoping I can toss it to the guy, the next person in line. And then that's when I make a profit. So that's the bottom line. Look for cash flow, guys.
I think that makes a ton of sense. And sticking to like the core fundamentals is what seems to work. I'm I'm curious, Matt, like so many of our listeners are just getting started with their real estate investing journey. And how do you think about passive investing in terms of where an investor is in their journey and when it's appropriate? If somebody is just getting started and maybe they don't have a ton of capital, should they go invest it into syndication and hopes for the big payday, or should they go do their own deals because then they get to keep all of the profits and hope that that deal goes well for them? How do you think about that?
Wow. What a great question. I think this is the best. Oh, it depends, Michael.
Yeah,
Yeah,
yeah.
depends. I'd have to like that's isn't that a great little dodge? I'd say if this and that, right? If this person lives in a home now that they love, that is their homestead, and they got a family, and they got a yard for the kids to run around in, and they got a dog running around the yard, and the whole thing. And they don't want to move. Then yeah, I get it. Then you can't do the first leg of investing, which I think all people should do. If you are listening, you listener are either renting or you live in a house you don't like, then your first investment should be all day long, hands down, a house hack. You should buy yourself a duplex, triplex. Find an agent you trust and buy a small multifamily up to 4 units, because you can get an FHA, first time home buyer, low money down mortgage. Even if you're not a first time home buyer, you can still get this mortgage. Get a low money down home mortgage at 3-5% down, and then put tenants in those other units, and you become a live-in landlord. That was my first real estate investment. So I think that somebody looking to get into the game that's got literally a few bucks, and I mean, not even dating myself, I bought a couple $100,000 property, my very first one that I lived in, with $4,500, Michael. That's all I brought to the table.
Holy
so
smokes.
You got more than you. If you got a couple of grand set aside, you can buy a low money down FHA backed first time home buyer insured house. Far and away, that's what you should be doing. If you're beyond that, if you've got the homestead, the house you like, and you're accredited, which Google it, but that means that's a rule set forth by the SEC. If you can invest in certain types of deals, including most syndications, right? If you're accredited, I suggest you want to put like 5K to work, if that's your risk tolerance, 10K to work or something like that. Go on one of the funding portals like CrowdStreet, Fundrise, one of those guys, and find an operator that's got a ton of seasoning on them. And most of them will allow you to come in at a very, very low minimum, 5K, 10K, 20K, something like that. You'd even go on the really, really low, scrappy fundraising portals like Republic.co or something like that. They take even smaller investments than that. You can even invest in non-real estate stuff. If that's your risk tolerance factor, then great. If you are accredited and you've got a significant amount of capital, like more than 25, 50K, or if you have a retirement account, most people don't realize this, but any retirement account that's not a 401k, if it's with the company that you don't work for anymore, if you used to work for company A and you now work for company B, retirement account for company A can be it is an IRA already, and it can be a self-directed, and you can put that self-directed IRA to work right now in a syndication. And most people should pull their IRAs off of Wall Street and put it to work in something that is more tangible, like a real estate syndication. And bottom line, above all else, find a syndicator that's transparent. Find one that's willing to pick up the phone when you call them and willing to teach you a few things along the way so that you can become a better, stronger investor by being a part of their communities and, talking to them directly, or their team that are willing to teach you and maybe help you invest more with them, but maybe also invest more with others too. So that's my advice on how to get going. And then bottom line, all in, it depends. But those are a few journeys or paths that one could take.
I like that. I like that a lot, Matt. I'm curious, like I've heard the argument pushing back on investing in real estate with a retirement account because people say, well, there's no depreciation benefit. Don't waste your money. What are your thoughts there?
Bullshit.
I love it.
Yeah, it's bullshit because, okay, depreciation benefits are all great, but if you're in a property that sells at some point, if you're in a forever hold property, it's going to depreciate its way to zero. Awesome. But at some point when that property sells, unless you do a 1031 exchange, you have to recapture that depreciation. It's not like the depreciation's forever, man. You got to give it back when you sell. All the IRA thing does is it negates that. And God willing, and the creek don't rise, the property you invested in sold for a lot more than what you bought it for. And hopefully you got in with one of these smoke and mirror crystal ball syndicators that sold it for 3x more than they paid for it, right, Michael?
Right.
And all that profit in your IRA becomes tax deferred, right? It's you want the benefit on the buy side or on the selling side. If you want the benefit on the buying side, that is where depreciation comes in, and it is a good factor, but it's cash. Like that's if you're a cash investor, then you get to kick the can down the road and defer those gains. But understand, it is a game. It is a cycle. And every time that property sells, you're going to be running around looking for another deal to invest in. You're going to try and talk to the syndicator into doing a 1031 exchange. You don't have to, you can roll the profits up and up and up and up and up. But understand that the selling side will kick you in the butt when you're a cash investor. They're creating a problem every time you sell. They're creating a tax problem. Now, on the IRA thing, yeah, you don't get the perks when you invest, but you get a huge perk when they sell. The biggest thing that an IRA investor needs to think about when they're investing in a syndication, and this is a real problem, but there's ways around it, and that is distributions. If I invest in Michael's deal, Michael's going out and buying himself a 100-unit apartment building, and I throw $50K from my IRA into it, and he's a great operator, does good things, and starts paying me distributions. He does the right thing, pays me 7% for the first year. 7% on my 50 grand is $3,500. He just paid that to me, to my retirement account. I can't touch it, right?
Okay.
The problem he has made for me is I now need to take $3,500 and put it to work in my retirement account. That, Michael, is a pain in the ass because it's in my retirement account, also with an IRA custodian. And those guys are pains in the asses because they like to charge you a fee for sneezing, you know?
Right.
They're going to be like, oh, $3,500, you want to invest that. They're not going to let you just go buy Bitcoin with it. They will, but they're going to charge you a fee. They're going to charge you a fee for putting it in stocks, a fee for putting it in this, putting it in that. What you want it, the best thing to do is to find a syndicator like Michael that will allow you to compound those returns into another one of his deals. So I want to say, Michael, listen, I get it. I love that you're producing 7% for me, but I don't want it. I want you to parlay it. Take that 7% and put it into, Michael's amazing fund 2. Okay. Take the syndication cash flow and put it in fund 2, or put it into your hard money initiatives that you have going on, or whatever it may be. That's the only thing that an IRA investor needs to know about is distributions can be a pain, but if you know what to do with them, then you can parlay those returns and grow them up and up and up and up.
Yeah, no, that makes a ton of sense. And what an interesting problem to have. Okay. So I'm who you're talking about. I'm this IRA investor, and I'm going to ask you a question live because I want your feedback. I want your advice. I've got a Roth.
DeRosaGroup.com.
You beat me to the punch. I love it. So I've got a Roth self-directed 401k. It's with Fidelity now, right? But I could easily make it self-directed. I have a custodian that I've worked with in the past. I've got some stocks that I'm down on, and I've got some stocks that I'm up on.
Yep. Which
would you recommend liquidating to go invest into a syndication?
Okay. I'm not.
And you can't say it depends.
No. I'm not. I'm going to say I'm not a super bullish stock guy, right? So I would, depends on what the down stocks are, right? Okay. If the fundamentals, I would call some people that you trust that are good stock people and say, hey, this is my down portfolio. Do you think that this is gonna keep going? Hey, people that are super hardcore blinders on stock, people are gonna tell you to dollar cost average, throw more money in, just bring more money to the casino and you'll be fine, right? Just go to the ATMs right over there. Just go to the ATM or in the casino, step back over to the blackjack table of Wall Street, and you'll be just fine.
Right.
But what I would do is I would take, you can't lose when you're winning, right? So I would take the win off the table, right? Maybe that's not the right way to say it, but I would take the win down, to take those chips off and invest that in something else. And if the losers you have are fundamentally sound with good things pointing in the right direction, with a few people that you trust telling you, yeah, man, I think you're all right. I think that's gonna come back around. Then I maybe would leave that out. I am not one that believes that the stock market's going to keep on climbing. And so if I were a bull, I'm a bear on the stock market. So if I were a bull, I would tell you to let the winners ride and pull the losers and cut the losers.
Right.
You know, that is a bull mentality, you know. But I would not, I'm a bear, and a bear is going to tell you, take your wins, maybe let the losers run. If your friends tell you the losers are going to stay losers, then I pull them down too.
Yeah.
You know?
All right.
Yeah.
I can work with that.
So there.
So the answer is DeRosaGroup.com. Yeah. Oh, Matt, this has been awesome, man. Ton of fun as always. If people want to learn more about you, want to reach out, want to invest with you, where's the best place for them to do so?
They can do it on our website, which I've...
what would that website be called? I can't...
I just shouted it like a douchebag the whole time. It's DeRosaGroup.com, guys. I'm not one of... Guys, just so you know, I'm not on this show. Michael and I go back from many years ago when he was with another company, which we don't need to mention today. But I'm here to chat with a good friend. I'm not here to promote the company. But if you'd like to hear more about what we're up to, it's at DeRosaGroup.com. We do, of course, take IRAs. We do have a couple of different funds you can consider and that. So we'd love to hear from you. We're a growing company, looking to get to the next level too. So
love it. Well, Matt, thanks again, man. This was awesome. And we'll catch up. We'll be catching up soon, I'm sure.
Yeah. Take care. Thanks, Michael.
All right, man. Likewise. All right, everyone. That was our show. A big thank you to Matt for coming on. Always a ton of fun to chat with him, having him on the show. If there are things that you want to hear more of or less of, please leave us a comment in the show notes. We'd love to hear from you all. Ratings and reviews are also really helpful to reach a bigger audience. And we look forward to seeing you on the next one. Happy investing.